So good afternoon, friends. We are down to the last session for dealing with accountant's perspective on IP. For dealing with the accountant's perspective on IP. And I've already been shown the ticker, so I'll keep that in mind as we proceed. Now, according to Forbes, Apple is the most powerful brand in the world. And it has been valued at some $145 billion. And this is quite a staggering valuation. And so just to give you a perspective, this is more than 150% of the bailout package which Greece economy got from Eurozone and IMF last year. But this is a bit confusing because if you look at the balance sheet of Apple, then neither this number nor any number close to this appears there. So we look down to the other top valuable brands of the world. And top 10 brands, if you look at whether it is Microsoft, Google, IBM, the result remains the same. The best result that you could get is Coca-Cola, which is the fourth most valuable brand in the world, with $60 billion of valuation. And its balance sheet says trademarks with indefinite useful lives worth $6 billion. So the difference lies here because the accounting regulations in America and other international jurisdictions prohibit companies to recognize brands which are internally developed by the companies. So that's where the challenge lies, and that's where, and this is not unique to America. Back home in India, we follow kind of similar regulations. And as India is trying to implement IFRS, International Financial Reporting Standards, the rules are going to be largely similar. So what it means is that accountants don't seem to be on the same page with the marketers. Because marketers believe that the financial reporting is not reflective of the true state of affairs of a company. But accountants try to justify their stand by going by the theory of prudence and conservatism. So, in this backdrop, I have been asked to talk about accountant's perspective, and going by this fact that accounting regulations do not permit recognition of IP brands as intangible assets. What are we going to discuss in next 5-10 minutes? If you are thinking that, then you are probably right in thinking so. So let me just try to address this aspect by adding a third party as well, and which are the tax authorities in India. And let me tell you that tax authorities can beat the marketers also by showing their enthusiasm in valuing the IP if it gives them higher tax collections. So let's try to resolve the difference in these approaches. So this is a survey. This is a very interesting survey carried out by one of the universities on BT 500 companies in India. And they come out with these findings that the nature of intangible assets disclosure in India is, very, very low. And see, these are the intangible assets: market share, distribution channel, brand valuation, business collaboration, and only 24% of the cases, 40% of the cases, these have been disclosed. So the level of disclosure on intangible assets by companies, if you look at the second chart from the left, it will show that 70 companies disclosed only 0 to 20% of the disclosures on intangible assets. And most of the companies fell in the range of 20 to 40%. So there is only one company which falls within the bracket of 80% to 100%. And there is only one more company which falls in the bracket of disclosure in the range of 60 to 80%. And of course, these are the top 5 scorers we have. Infosys is the company which is disclosed highest on intangible assets so far. And of course, if you look at the industry-wise disclosure, then information, communication, and entertainment is the torchbearer on disclosing intangible assets. So these are the broad findings: low level of disclosure on intangible assets. Reporting of intangible assets in balance sheets is not fairly organized, and it's mainly qualitative. So you will get, good prose and literature on intangible assets, but when it comes to valuation, when it comes to numbers, then the picture is a bit different. And reporting is mainly around mandatory disclosure norms. So whatever accounting regulations that we have, they prescribe certain mandatory disclosure requirements for companies, and that's what we have. So voluntary disclosures is a bit lacking in the company. And highest mean disclosure score by IT is by IT industries. Now, so this is another survey, top 10 most powerful brands in India by Brand Finance India in 2015. And this is the brand valuation done for each of these brands. And let me tell you, if we look at the balance sheets of these companies, the 90% of this value is not captured in the financial accounts. And again, this is because the differences in the approaches of marketers and accountants. So let's take a look at the accounting regulations. Recognition in balance sheet. So if a company carries out research and development, then it is recognized as intangible asset only if it is supported by technical and feasibility study. So for example, if Google is, let's say, investing in a driverless car today, then until its economic and technical feasibility is proved, you will not be allowed to capitalize the same and show it as asset in your balance sheet. Because all other R&D efforts, if they don't satisfy this test, then they are charged off to profit and loss account as expenses. Now the other aspect is very interesting, acquired assets versus self-generated assets. I started by saying that accounting rules do not permit companies to recognize IP in their balance sheet. In 2005, one of my clients, Gillette, was acquired globally by Procter & Gamble. And the valuation done was about $57 billion or so, with